You're watching The Market Comment for Monday, July 31st by Raf Boyajian. I'm Christina Marujas, and thank you for joining us at XM.com. The market's conviction that the Fed's July rate hike was a one and done got a boost on Friday after the central bank's favorite inflation metric fell more than expected, underscoring the view that price pressures no longer pose a major risk. The core PCE price index dropped to 4.1% year-on-year in July, the first substantial decline since December. Whilst the figure is twice the Fed's 2% target, it was the signal investors were waiting for that monetary policy is restrictive enough. The focus now is on Friday's all-important jobs report amid some worries that the labor market may be heating up again after the recent run of stronger-than-expected jobless claims readings. Bond markets remain unconvinced about the all-clear sign that stock markets are seeing, which for equity traders, this is the Goldilocks situation they've been hoping for. Moreover, after Meta's and Alphabet's strong earnings beats, there are hopes that Apple and Amazon will deliver more of the same when they report later this week. The Nasdaq Composite rallied on Friday to close 1.9% higher, while the S&P 500 closed up 1%. Shares in Asia are leading the gains today amid more reports that authorities in China are prepping additional stimulus measures. In the currency markets, the US dollar was broadly firmer, mainly on the back of the fresh sell-off in the Japanese yen. The euro remained mostly on the back foot, while sterling was weaker too on Monday ahead of the Bank of England's rate decision on Thursday. Commodity-linked currencies bucked the trend, and the Australian dollar is today's biggest gainer so far, but there is a risk of a pullback should the Reserve Bank of Australia keep rates unchanged when it meets on Tuesday. The yen, on the other hand, slid across the board after the Bank of Japan conducted an unscheduled bond buying operation to cap the surge in the 10-year JGB yield. Japan's 10-year yield has shot up to the highest in 9 years after the Bank of Japan shocked markets on Friday with a surprise tweak in its yield curve control policy. The jump to above 0.6% has clearly struck a nerve with policymakers, with the yen suffering the consequences. This was today's market comment here at XM.com. Have a great week.